Before really understanding YieldMax ETFs, I just dismissed them. I labeled them as terrible investments, and I think I was harsh on my judgment based on a surface level assessment. However, after looking into them, I have a dilemma. I need to know, what am I missing? They pay a ridiculously high dividend yield, and that is by design and is sustainable. Sometimes it's as high as like 200%. Yes, you heard that correctly, 200%. Sometimes it's as low as like 40 to 50%. It almost sounds too good to be true. So what am I missing? So based on my understanding of YieldMax ETFs, this is how they work. The YieldMax fund managers, they actually don't own any stock or shares of the underlying asset. They do options. So for instance, they'll have a YieldMax ETF on Amazon and they'll call it Amazely. So when you get dividends, they're technically distributions from 3 different sources within that ETF. Number 1, the option premium income from selling puts. Number 2, gains from purchasing calls that land in the money. And number 3, interest on cash through government bonds and high yield interest vehicles. Now, for example, let's take a look at Misty. This is their ETF on MicroStrategy. It's a company that is a parallel play to Bitcoin or cryptocurrency. And because it's an ETF, you would assume their portfolio would be majority or 90% into options of MicroStrategy. But what you see on your screen right now, shocking to say the least. 60% of their portfolio weighting of the allocation of the money that they have in that ETF allocated towards cash and cash equivalents. The next biggest bulk is United States Treasury note bonds, and then the next biggest bulk is also United States Treasury bonds, government notes, and so on and so forth until you reach this column right here. 4% of the capital's assets are allocated towards calls for MicroStrategy that's expiring on May the 16th at 4%. So the strategy of the YieldMax ETF is pretty conservative when you think about it, because the majority and a dominant position is in cash and in treasury notes. Because I think they prioritize stability, liquidity, and to have a conservative risk approach given the really risky nature of options. So now that I understand what YieldMax ETFs are, how they make their money and how they distribute it as dividends, and what the holdings look like within a single ETF, well, now I want to talk about what exactly is the bull case for this income generation ETF that is taking the dividend investing community by storm. Dude, everybody is talking about it. Everybody is in love with it. Well, number 1 is to quit your 9 to 5, your primary source of income. That's the marketing message behind YieldMax ETFs. That way you can replace that active income that you spend 40 to 60 hours a week to make money instead with passive income from the YieldMax dividend distributions. So in lieu of physically going to a job, you can have your money work for you via these distributions that are paid out every single month. And now they even have ETFs that pay out every week. And then number 2, I want to talk about this and address it because I think it's the biggest pushback, concern, and call out surrounding YieldMax ETFs. And that's the NAV erosion, the net asset value, the share price appreciation. And to that, I think the community says if the price drops a lot, then they can buy more shares of that specific YieldMax ETF, eventually returning more distributions in the end. So are they technically and really losing in the end if they're able to buy more shares to accumulate it at a lower price and to increase their dividend output? And the bull case point number 3 is the tax loss harvest the principal amount. And I have a sub bullet there saying, what? Well, let's look at an example. So continuing on with the example of Misty of MicroStrategy, their current dividend yield right now is 162%. Yes, you heard that correctly. 162% dividend yield, which means in the past 12 months, TTM, the annual dividend payout was $33.19. Now, let's go ahead and assume that you bought it 1 year ago, April 1st, at the very juicy price of $42.23 a share. Now, fast forward 12 months later, now that share price is, as you can see on your screen right now, $20.37. which means your unrealized loss, the paper loss, negative $21.86. However, because the dividend distribution and the dividend payout is so high, you're actually going to be able to walk away in the green. So, even though the share price went down by, 51%, negative $21.86, because of the positive dividend distribution of $33.19, your 1-year profit is $11.33. Which means if I were to sell it at a loss, then I can do tax loss harvesting on the share amount, but still be in the green with $11 through those dividends. Which means I can utilize Misty's tax loss up to $3,000 a year to offset some other capital gains. And again, let's go ahead and do one more YieldMax ETF example to grasp the concept. So let's say I bought into YieldMax, which is an ETF consisting of all of the YieldMax ETFs. Currently, their dividend yield is 62%, which means for the past 12 months, the annual dividend payout was $8.43. And let's go ahead and make the same assumption that you bought into YieldMax 1 year ago on April 1st, 2024 at a price of $21.60. Since then, the NAV erosion, it went down by 37%, and now it's $13.50. Which means the unrealized paper loss is $8.10. However, because the annual dividend payout is $8.43, it's higher than the paper loss, so the 1-year profit of holding on to YieldMax is actually plus 33 cents. Again, you walk away in the green. So in a way, it's kind of like by investing into a YieldMax ETF, you buy into it for $100 and it goes down by like $50, but by 1 year, you end up getting all of the $100 back in dividends. Not exactly, but kind of. To my understanding, please correct me if I'm wrong. It's basically what I'm saying. And before we go any further, I wanted to give a shout out and highlight some comments that were posted on my most recent video talking about SCHD. I genuinely made that video because I was indecisive on whether or not I wanted to buy into the Dividend King ETF, the one that's so popular, everybody seems to like it. Right? It doesn't matter if you're handsome or you're ugly, everybody likes SCHD. But for me, I was looking at it from like a third-party perspective of like, should I buy into it? Now let's see some of y'all's responses. Number 1, from Diresh. I buy SCHD for the methodology. Very strict screening process in order to join the Dow Jones US Dividend 100 Index, by the way. I like that it is opportunistic and squeeze the juice out of companies that are healthy today, and then they toss them aside when their fundamentals deteriorate. That way I don't have to worry about long term for many holdings. If I have a high conviction over the long term, I can just buy that stock outright. I fundamentally, wholeheartedly agree with that assessment and that opinion. I think SCHD does a really good job of finding and congregating all the companies that have really good dividend growth, dividend yield, but also positive free cash flow in comparison to their debt picture. And then they milk them for all of the dividends that they can give out. And then they toss them aside and rotate it out with another company once their financials or their metrics and their business starts to go on the decline. So in one sense, I think SCHD makes too much sense. And that's why for the past 20 years, their average dividend growth rate is 11.5%. And the current dividend yield is somewhere around 3.4 to 3.6%. So I think for me, SCHD is a screaming buy, but I have yet to pull the trigger. I know, I'm being absolutely weird and bizarre, and that's because I truly think that SCHD might go down to like 25 or even $25.50 a share, and then at which point I'll rethink about it and I'll probably buy into it. So I guess I'm trying to quote unquote time the market. And then another comment that I want to highlight is by Jonathan Kelly, 1979. I am buying into SCHD. I have it as an index fund that is hedged against the current tech bubble. When you think about SCHD's holdings, it's overwhelmingly pharmaceuticals, insurance companies, and financial firms. SCHD has very limited exposure to the tech space. I think one of their biggest players is Cisco, and that's because their dividend yield is like 3+%. Anyways, he goes on to say, it follows the up into the right philosophy. So because of their strategy, the ETF's share price goes up and to the right. So it's a good thing. And I agree with him as well, because when you think about the S&P 500 or the NASDAQ 100, the Mag 7, when you think about Amazon, Microsoft, Google, Apple, they just have way too much power and influence and the weighting of those indexes. However, with SCHD, no single company can have more than 4% of the portfolio's allocation. And so it evenly distributes the risk across all the different 100 companies within the index. And I really like that, because I think on one hand, it balances out the overly optimistic companies where their trading multiple is just way too high to justify and validate. And on the other, it's comprised of undervalued companies that are just very solid and are just flying under the radar of most investors. And so when they meet in the middle, it's comprised of companies that are just very good. However, they're not going to have bonker numbers like Nvidia or Amazon or Tesla. So by sacrificing some of the potential gains you can get from the Mag 7 stocks, you also get rid of the volatility as well. I think for the past 10 to 15 years, the lowest that SCHD has ever gotten by their share price appreciation in a single year was like negative 3.5%. So when I think about SCHD on a volatility scale and level, I think it's a fundamentally really good ETF. And that's why I can recommend it to friends and family who know that investing is good, but they don't want to spend too much time researching individual companies. I think SCHD and an S&P 500 ETF, just those two, and you're good to go for almost every case and example. Obviously, there's some outlier examples that require additional input and output, such as like treasury bonds and whatnot. But for the most part, I would argue 95% of the people out there, you're good to go with SCHD and an S&P 500 ETF. And call it a day. And last but not least, let's address what Nathan Chu 759 wrote. He said, "You kind of look like Stephen Yoon." Now listen here, Buster. I've been called a lot of things in my life before, ugly being one of them, but I have never ever been told that I resemble Stephen Yoon. But I'm going to go ahead and take that as a compliment because I think he is a handsome young man. And I say young man, even though he's a little bit older than me. But getting back on track with YieldMax ETFs, let's talk about the arguments that are against this specific investment choice. Number one, when your NAV is gone, so is your income. A 200% dividend yield, it doesn't matter if the share price just deteriorates. If it goes from $10 down to $5 and eventually $1 and then $0, the dividend yield could be 1,000%. But if the share price drops down to $0, you're getting nothing. And that's why NAV erosion is also referred to as yield traps. As their NAV decreases or the share price, if it shrinks, the dividend payout is also going to get smaller and smaller. So for example, let's say you have $100 invested into a YieldMax ETF fund. And let's say that you get $5 a month for the first year. Pretty juicy and solid dividend yield. And then the next year, because their NAV keeps shrinking and decreasing in the share price, now you get about $2 every month for your distribution. And the worst part is, your initial investment, it shrunk by $50. So your $100 invested went down by 50%, and now you have $50, and now you're getting paid less dividends every month. So if you sell, you only get 50% of your original investment back. That's a real possibility and something that has happened with some of the YieldMax ETFs. And number two, their history is very, very short. Their take on the synthetic covered call strategy has been employed since 2022 when they launched Tesla, the options income ETF for Tesla. We don't know how they're going to perform in a bear market, during a recession, or 5 years from now. And although some of the YieldMax ETFs have been absolutely crushing it, The other ones, not so much. For instance, let's go ahead and take a look at Tesla's total return when we take into consideration their dividends paid out. So not just the share price, but also dividends paid out, the total return, the CAGR. So as of right now, Tesla's dividend yield is 121%. It's quite juicy, it's quite big. Wow. Which means the annual dividend payout is $10.09. However, when we look at the past 3 years, or since their ETF inception date of November of 2022 till now, you fast forward about 2.5 to 3 years later, your total return on investment, if you bought into them in the very beginning, you would have been down in the red by negative 5.8%. That's not good. And in the beginning, God created the heavens and the earth, but also in November of 2022, they debuted at $40, roughly $43 a share. Consequently, their dividends were also quite high. When we look at the beginning, they used to pay about $1.99 every month. And then it went down to $1.80. And if you fast forward to what it is today, because the NAV price has been eroded to a certain degree, now the dividend payout is also shrinking alongside with it. So since the beginning of 2025, the dividend payout every month went from 71 cents down to 57 cents, down to 46 cents. And if a trend is any indicator of what's going to happen in April and May, I'm going to also assume that this dividend payout is going to go down to like 41 cents and then 38 cents. So this $1.99 dividend was evident when the share price was about $40. However, as of right now, because Tesla is $8.32, it cannot pay $1.99. It can't sustain that dividend every 30 days. And before accusations are made that I'm cherry picking with Tesla, let's go ahead and take a look at one more YieldMax ETF, and that's going to be Connie. It's the YieldMax ETF for Coinbase. Their current dividend yield right now is 224%. That is absolutely wild, which means the annual dividend payout is $17.35 to that of their current share price of $7.73. So it's paying out double its share price in dividends for the past trailing 12 months. And since their inception, August of 2023 to what it is today, the total return on investment, you would be in the green by 75% because of the ridiculously high dividend payout. Even if the share price got absolutely demolished, because of the dividends, you're still in the green. And that's why I think the adjusted stock price total return is a more holistic picture that you should use to evaluate and judge a dividend compounder or dividend paying stock. Because the dividends help complete the performance picture. Because when you pull up a stock on Yahoo Finance or on Google or on Robinhood, they only show you the share price appreciation. They don't take into consideration the dividends paid out. So when Connie debuted in August of 2023 at $18.42, since then they've gone into the red by negative 58% for their share price. And you would think this is absolutely disgusting, horrific, get it away from me, until you learn that their dividend payout has just been a monster and has been sustainable and reliable. Because as you can see by their dividend payout schedule every single month, sometimes it's like $1.20 every 30 days, absolutely bonkers. And sometimes it goes up to $2.46. And it goes on a trend, right? Sometimes it goes down, sometimes it goes up. However, as of recently, November of 2024, they paid out $2.02 that month. And now it's going down. And if a trend is any indicator of what's going to happen in the future, maybe if their fund managers can pull it off and execute their strategy to a T, the next dividend payout, maybe like in 3 to 4 months from now, it'll go back up to $2 or even $2.40 a share for that single month, if they can do it. And let's just do one more example. Amazy. This is the Amazon YieldMax ETF. Current share price is $16.23. The dividend yield is 53%. So I think out of the entire YieldMax ETF portfolio, this one is probably on the lower end of the dividend yield scale, which means the dividend payout for the past 12 months has been $8.68. And since their inception of July of 2023, the total return is 45%. Just something to take into consideration and to think about. And that's why I'm having this dilemma when it comes to YieldMax ETFs. Because on surface level, when I took a look at their share price appreciation, how it's down by -50, -60%, dude, I just dismissed them. But after learning about how you still walk away in the green, despite the share price being demolished because of the high dividends, I don't know what to think anymore. Which brings me to my conclusion, I'm skeptical. I want to like them based on the data and the math and their history, but I have some questions, right? Their strategy works right now. I mean, it has for the past 2 to 3 years, the synthetic covered call, generating income. However, my whole thing is it works until it doesn't. We genuinely don't know how the fund managers are going to execute their strategy during a recession or a bear market. And then also number 2 is, if you like this income generating ETF that pays a dividend yield that's really high, why not just take a look at high dividend yield BDCs or REITs, where their NAV is not going to get demolished by 50% in 1 calendar year. I mean, granted, you're not going to see a dividend yield of 200% when it comes to a BDC like Main Street Capital or ARC or Realty Income Corporation. It's not going to be that high. However, with a modest dividend yield that is sustainable and is more reliable at about 6 to 11%, I mean, the investment thesis sells itself. There's no such thing as a safe stock in the stock market. However, with REITs and BDCs, when you buy into it at about $20 a share, a year from now, most likely going to be 21 or 22 bucks a share. Just throwing numbers out there. But with a YieldMax ETF, if you buy into one that is 20 bucks, based on their history and the data that's available, at 20 bucks a year from now, most likely going to be like 13 or 12 bucks the share price. And if you are absolutely in love with cover call ETFs that produce an income, why not go the JEPI or JEPQ route, the JP Morgan's version of the YieldMax ETF? Granted, yes, their dividend yield is what, 6% to maybe as high as 10%. Not that high, but their NAV erosion has been kept to a minimum. And because I'm still on the fence about YieldMax ETFs, if you are invested into YieldMax ETFs and you continue to buy them, please tell me, what is your or the YieldMax ETFs investing thesis? This is not an attack, and I'm not just fishing for comments. I genuinely want engagement because I want to learn and I want to see from your point of view. Now, with all of that said, before you go, I just wanted to say this. Being a very good husband and a good father is a very underappreciated role. So I wanted to say good job, keep doing you. Here's your pat on the back, my friend. I love you, stay safe, good luck in the stock market, and I'll talk to you next time. Peace.